All right, welcome back. Again, another leverage problem, slightly different from the previous one. All right, where we have to calculate EPS and debenture value from the from the data that is provided here. All right. Now, sales is 20 lakh units or 2 million units at the rate of 20 rupees per unit. Contribution is 10 lakhs, a million. Existing DOL, degree of operating leverage, is 2.5. Equity capital is 1 lakh shares of rupees 10 each. So the total equity capital will be 10 lakhs. Tax rate is 50%. Interest on debentures is 16%. Calculate EPS and debenture value. Now, the interest on debenture is given 16%, but we do not know what is the debenture value. We have to find. So, calculate EPS and debenture value if a 25% decline in sales will wipe out EPS. All right, interesting problem. Okay, so income statement. All right, now you show existing sales. All right, and decline in sales by 5%. So decline in sales by 25%. All right, so sales is going to decline. All right, so show sales minus variable cost. Now, what is sales? Sales is given. Existing sales is 20 lakh units at the rate of 20 unit. So that is around 4 crores. All right, minus variable cost. Now, what is variable cost? Is it given? It's not given, but we know what is contribution. What is contribution? Contribution is 10 lakhs. So therefore, variable cost will be 3 lakhs or 3 crores 90 lakhs minus fixed cost. What is fixed cost? We are yet to find out. Then after fixed costs, contribution minus fixed cost is earnings before interest and tax. We have to find out. Then minus interest, okay, at 16%. Interest rate is 16%. So EBIT minus interest is earnings before taxes. Then minus tax rate is at 50%. We have to find out all these value. Then EBT minus tax is EAT, earnings after tax. Earnings after tax minus preference dividend. All right. So finally you have equity earnings. Now, it says here that we have to calculate EPS and debenture value if a 25% decline in sales will wipe out EPS. Now, a decline in sales by 25%, that means it's going to be 3 crores, right? Because a 25% of 4 crores is 1 crore. So we are left with 3 crores. All right. Obviously, this will also decline by 25% variable costs. So 2 crores 92 lakhs 50,000. All right. Now, this will be 75 lakhs. Okay, we do not know what is fixed cost. We have to find out. Now, how will you find out fixed costs? See, we need to find out EBIT first. How will you find out EBIT? The clue is given. All right, where's the hint? Existing DOL is 2.5. Now, what is existing DOL? So DOL is equal to contribution by EBIT. Do we know what is EBIT? We don't. Do we know what is contribution? Yes. 10 lakhs. And we know what is DOL also. 2.5. So 2.5 is equal to 10 lakhs divided by EBIT. So therefore EBIT will be equal to 4 lakhs. Alright. So EBIT is 4 lakhs. So we found out EBIT is 4 lakhs. So if EBIT is 4 lakhs, then obviously fixed costs will be what? Will be 6 lakhs. Because 10 lakhs minus 6 lakhs will give you 4 lakhs. Now fixed costs, irrespective of increase in sales or decline in sales, your fixed costs, fixed operating costs always remains the same. So here it will also be 6 lakhs. All right. Wait, I made a mistake here. This is 7 lakhs 50,000. Okay, 7 lakhs 50,000. Sorry for that, scribbling. All right, please bear with me. So it's 7 lakhs 50,000. It cannot be, yeah, since it's 10 lakhs or 7 lakhs. Okay, so this will be 1 lakh 50,000. All right, so there. Now, it says here that a decline in sales, a 25% decline in sales will wipe out EPS. Okay. Now, when will EPS be wiped out? What is EPS, by the way? EPS, earnings per share, is equal to equity earnings divided by the number of equity shares, right? Divided by the number of equity shares. Now, when will EPS be wiped out? Do we know what is the number of equity shares here? Yes, it's given. 1 lakh equity shares, so 1 lakh. Now, equity shares, EPS is equal to equity shares, equity earnings divided by number of equity shares. Now, when will EPS be 0, wiped out? EPS will be 0 when your equity earnings is 0, right? So 0 divided by 1 lakh is equal to 0. So here, a decline in sales, all right, a decline in sales will wipe out, 25% decline in sales will wipe out EPS. So when will EPS be wiped out? Will be 0 when equity earnings is 0. Okay, when will equity earnings be 0? When your preference dividend is 0 and your EAT, earnings after tax, is also 0, and where your tax is also 0. All right, and not only that, your EBT is also 0. All right, so now the interest is 1 lakh 50,000. All right, why? Because 1 lakh 50,000 minus 1 lakh 50,000 will give you 0 here. All right, now again, just like fixed cost does not change. So the interest on debenture value will also not change whether there's a decline or increase in sales. All right, so if it is 1 lakh 50,000 here also it will be 1 lakh 50,000. All right, 1 lakh 50,000. So what is EBT? EBT will be 4 lakhs minus 1 lakh 50,000 will be 2 lakhs 50,000. What is the tax rate at 50%? So it will be 1 lakh 25. Alright, so EAT will be 1,25,000. Alright, is there any preference dividend? No preference dividend. So therefore, your equity earnings is 1,25,000. Your equity earnings is 1,25,000. Now, you're supposed to find out what is calculate EPS. So, EPS under existing sales, EPS will be equal to equity earnings, which you found out 1,25,000, divided by the number of equity shares outstanding, which is 1 lakh. So therefore, 1,25,000. So EPS will be, earnings per share will be rupees 1.25. All right. So we have done with EPS. Now we have to calculate what is debenture value. Now, what is the debenture value? All right. Now the interest is given. Debenture interest is 16%. It is given in the problem, 16%, and therefore, and your interest is also given. It's given. Interest is what? Is 1,50,000. So therefore, your debenture value, okay, debenture value will be equal, debenture value will be equal to 1,50,000 into 100 divided by 16. So that works out to 9,37,500. So that is how you solve a problem like this. Okay, so we found out the EPS as well as the debenture value. All right.